Hello, I'm Anna Marie De La Vega. Thank you for joining us today for Focus. Today, we have one of our most knowledgeable, most helpful, most informative, and one of our favorite guests, Paris Jackson, joining us. She's a financial advisor with Northwestern Mutual. Thank you for coming back, Paris.
Thank you, Anna Marie.
You've been here before, yet you keep coming back.
I do.
Because there's so much that you can help us with.
Yeah.
And especially around tax time, or especially around the end of the year, first of the year, people start stressing out about filing those taxes, what to do, so what to get together, what to look out for.
Yeah.
So we want to hit that first.
Okay.
How about some tips you should know before filing your taxes?
Okay. Well, the first thing I will tell you is to definitely be accurate in what you are reporting. Oftentimes people get tax notices 2, 3, 4, 5 years later of something that wasn't reported. So just make sure that everything that was earned is reported. Some of the biggest things that I see is interest off of investment accounts may not be reported, or someone who may have like a side gig, they may not report that income. But just make sure you know that all financial firms report the information over to the IRS. And anything that has your social tie to it is definitely going to get reported. So just be accurate in everything that you're reporting is my first tip. The second thing is to make sure you double check all your personal info. So sometimes it seems like that's not important, but sometimes, clients can have a hard time even reaching someone on the IRS website or telephone because their address is not accurate. So just double check the information that you're using to file your taxes, because that is how you can get in contact with someone if you actually need assistance.
Okay.
The third thing is to make sure that we don't miss out on any tax credits. And sometimes that requires working with a professional or just looking up the updated information on irs.gov just to make sure you're aware of all of the changes. There are quite a few changes for 2026. One, for instance, is the health savings account for people has opened up and expanded. So it used to be that you were required to have a high deductible health plan in order to qualify to save in a health savings account. And a health savings account allows people to place savings in an account that you can also, invest that money, and you can use it for qualified health expenses. And so now there's 3 categories of health plans. There's catastrophic, bronze, and high deductible health. With the One Big Beautiful Bill, you are now allowed to contribute to an HSA regardless of which health plan you have. So that's something new for 2026. And people can use those funds next year if they're able to qualify for it or put it into that account. They can use that as a tax deduction for next year, which lowers the amount of money that you're being paid taxes on.
How do you contribute to an HSA? Is it through the insurance or your what?
Yeah. So if you have an employer, some employers offer HSA plans, and they even offer somewhat of a match to it. Like the employer can contribute $100 to $150 a year. And then you as an individual can contribute as well. The amount that you can contribute is based off of your household. So married versus, having kids and things like that. So definitely look up those particular rates that fit you and your family. But business owners can open them as well. And so if you have an individual health plan, that health plan corresponds to the health savings account that you can save and put money away for, future health costs. And it does move with you from year to year, right? So it's an additional savings plans that is, it grows tax deferred. And then if you pull out the money for qualified health expenses, it's tax free.
Am I able to start it on my own as an individual? Or does it have to go?
If you're a business owner.
Only a business owner. Okay, gotcha.
And then number 4 would be to check for your 401k opportunities as far as another tax deduction. And so for 401k, solo 401k, traditional IRAs, anything that has a tax deductible component to it. So if I'm contributing to a retirement account and I want to claim that as, again, same thing as an HSA, money that I don't want to pay taxes on or reduce the amount of money, those contributions can count as deductions for your taxes.
I wish I had known that a couple of years ago, because my income was just above a certain level and it made our taxes be higher.
Mm-hmm.
And I didn't realize I could have contributed more to the 401k
Mm-hmm.
and offset that.
Yep. So last year was up to 23.5. And so the actual tip is you have up until April 15th to make contributions for 2025. So even if someone is contributing now and they need to lower their tax liability, you can still make those contributions for the previous year up until April 15th.
Whoa, that's good. Okay, got it.
And then the last one is to file electronically, opt for, direct deposit, and make sure that you have a tracking mechanism for your tax records, because you never know when you may have to refer back to them if there's any type of audit. And just keep up with all your tax documents, no matter how long, it could be 10, 15 years. Keep a track of everything that you have.
Oh, really? Like online? Can you store them online, or do you have to have those hard copies to pull out in a folder?
Sometimes it's better to have hard copies. I store mine digitally on a computer, and we also print off and put it in our safe. We had a case where we had to reference back to 2001 for an investment document. And so, most companies only keep records on file for 10 years. So if you need anything past that, you're probably going to be the one to have a copy.
So my husband's saving tax records from 20 years ago is okay.
It's okay.
Oh,
yeah.
no. Oh, no.
Don't tell him I said that.
I know I have to eat all those words. I have to find a way to unshred all those papers. Okay, so update your personal information. Make sure you have all your tax forms and all the contacts that you've made online, the things you filed, and the online work that you've done with the IRS. And if we need help, just make sure our information is correct. So the IRS knows who they're talking to.
Yeah. And then understand when it's an important point in your, career to bring in a CPA who understands taxes and keeps up with all the laws and things that are changing. As an advisor, it's good for us to work in tandem with the client, with their CPA, to understand what they should be contributing to certain investment accounts based off of, how they're filing. And this is more so for business owners.
Yeah.
Like if you have a business and you have certain accounts established, there's limits on what you can put in based on the income that you have. So understanding those numbers can definitely keep you out of a lot of trouble because there's penalties if we do the wrong thing or put money in the wrong places.
Mm-hmm. And I know we had dealt with something like, this was not tax deferred, or this was taxable income in investments and stuff like that, where it didn't really need to be.
Right.
And so that's what you can guide your clients on.
Yes.
Okay, good. I like that a lot. Anything else that people should know about, things that have changed that they need to be aware of? Or what about people there are a lot of people doing side gigs who are self-employed. What do they need to keep up with?
Expenses. I would definitely recommend an expense tracker to keep track of, whether you use your vehicle for personal or business. Keep track of the mileage that you have from the beginning of the year until the 31st of December. Look at the authorizations from the IRS perspective on whether you operate your business from home or you have, an actual building, because there are components of your home that you can claim as a tax deduction. Okay. Keep receipts for everything. Another tip is to separate your expenses. Have a business credit card so that you can keep your personal expenses separated from the business expenses, because a lot of times you can claim certain interest fees for your actual business. There are some new tax laws, like if you bought a brand new vehicle that was built in the U.S. in 2025, you can claim the interest on what you've been paying. You can claim that interest as a tax deduction for 2026.
Whoa.
What else?
That's a biggie.
It is a biggie. For seniors, there's a $6,000 standard deduction. I don't remember whether or not it was for married couples or just seniors as individuals, but definitely this is a space to go onto the irs.gov website. They have all of the updates added from the new tax laws for 2026. And so there may be things that definitely apply to you that if you're filing on your own, you may not know about.
Yeah. It's not just the old ones that you're used to. Well, let me keep track of all my donations to Goodwill and things like that. The deductions are bigger. The automatic deductions are bigger, and you might not have to do all of that.
Right. Case in point, my daughter filed her taxes. She's a server. She worked for tips. Biggest part of the One Big Beautiful bill is not paying taxes on those tips. So she was in a space where she owed prior to that, and now she doesn't. She actually got a refund. So definitely take a look at all the updates.
That's a big one for servers.
Huge, yeah.
Because they're busting their butt. And no, that's very good. Okay, so anything else that you can think of before we move on from the tax tips?
No, I think that's it.
Okay, and if they want to work with a financial advisor, they could come see you.
They can. I'm definitely not a tax expert, but I work in tandem with a lot of CPAs and clients to have familiarity. But I would definitely, love to partner with the client and their CPA.
Good. Paris Jackson is a financial advisor with Northwestern Mutual, and I feel she's the best. She's just amazing. And so
thank you, Anna.
You get my personal recommendation for what that's worth. So next we want to talk about spring cleaning your finances. I never thought of it that way. Have a financial reset.
Yeah.
What does that mean?
You know me. You know me, Anna Marie. It always comes back down to facing what we're doing, right? I think the biggest thing to do in a reset is to look at where the money has been going. During the wintertime, if you want to look back at the past 6 months, from fall through winter, what have I done with my money? What expenses have occurred? And where am I? And so in order to reset, we have to know where we started. But the biggest thing is cleaning up the things that we don't need or the things that we want but are not necessary in a season that we're walking into. And so some of the things can be, okay, we stayed in the house for the winter. And, I had Netflix and Hulu and all these because it was cold.
Yeah.
And I stayed inside and I watched a lot more TV. Well, maybe I don't need all of those subscriptions for the spring and the summer. I know for me, Hulu was something that we did in the wintertime because we're watching football and basketball, but we're outside more. And so I don't need that subscription for the next 6 months.
Yeah.
So that can be an opportunity to reroute that, $90 into an emergency fund or into an investment account.
I like that you said reroute because we don't do that. We just cancel it.
We cancel it like, I have more money.
And just to spend on whatever. We can go out again.
Yeah.
Okay, so next.
And so next is to identify any upcoming expenses, I think more so for families. We're right at the tail end of winter, heading into spring. This year is a little weird because I don't know what's going on. They're at a battle. But summer is definitely going to come up and kids are going to be out of school. So organizing your budget to be able to accept the increase in grocery bills and things like that we don't naturally, we know it's coming, but we don't think to prepare for it. So just taking a look at your budget and seeing ways to reorganize money so that we can prepare for the upcoming expenses of the summer. Also with spring cleaning is looking at, job income and opportunities. Is there anything coming up that you may get from a pay increase perspective that's going to change the outlook of your finances? Or if there's any bills that we know that are going to increases that may require us to look at other opportunities to, possibly have a side gig or anything, just laying eyes on whether I have enough coming in to support everything that has to go out and then making decisions from there on, do I need to bring in more income or do I need to let some things go?
Yeah, spend less.
Yeah.
Because you really only have those options.
There's the only two?
Well, no. You also have pulling out the credit cards and getting into debt and getting into a jam.
Not a viable option, but we do it.
We do it, but it is reality. And you're here to help, and financial advisors overall are here to help us not go down that path.
Yeah.
And get in so deeply we just can't see light of day anymore.
Yeah.
Because people do.
People do.
And what was it you said about how, before we go more into that, because I'm sidetracking a little, what is it you said about how you were raised and how your parents handle money?
Yeah, we tend to naturally, whether we realize it or not, we adapt those habits that we saw. And so sometimes living paycheck to paycheck feels comfortable.
Yeah.
Right. And so we don't make any adjustments, or we saw our parents figure out how to make summer fun by, racking up credit card debt and things like that. And so that's what we were taught to do as, things being okay, instead of saying, okay, let's do a spring clean. Let's look at our budget and figure out something new to do, so that at the end of the year, when we're looking back, we can be proud of the decisions that we made.
Yes. Yes. And the decisions that we taught our kids to make.
Mm-hmm.
I saw a video just recently, and this is adjacent to that. It was talking about the way you show love to people is something you learned, like you learned to speak your language as you were growing up. You don't remember when suddenly you could speak English. You just learned it because was what was all around you. You learned to show love this same way. And you learned to do your finances the same way. There's so many things that you learn as a kid that you have no idea. You're learning a whole other, this is how I do this. This is another system. This is how I do that. So we're trying to break that cycle.
We are. Yeah.
Okay. And a financial advisor is a great, great place to get started on that. Paris Jackson, financial advisor with Northwestern Mutual. We're talking about spring cleaning your finances and having a financial reset.
So we talked already about, reviewing subscriptions and recurring charges that we may not necessarily need in the summer. We talked about refreshing the budget and looking over those things. This is also a really good time to tackle any high interest credit card debt, anything that may be prioritized as more important for the rest of the year than some other things in your budget. It's also a really good time to look at the savings opportunities that we have. How much am I contributing to my 401k versus what I have in my emergency fund? Do I need to, reduce one and increase the other, or vice versa? So looking at our savings opportunities and optimizing any investments that we have. Another good thing to do is organize any important documents.
No.
One of the, right. So we talked, earlier about taxes, but those are not the only documents we need to make sure that we have a hold of. So any life insurance policies, make sure you have a copy of that, and make sure your beneficiaries are updated is a good part of spring cleaning, as well as looking into your bank accounts, right? Do your bank accounts have payable on death beneficiaries, so that if something happens to you, that account doesn't go into probate and your family is spending time in the courts trying to get access to that money.
Whoa.
And then just making sure that, we're looking at wills and trust and any estate planning needs that we may have, and understanding that our wishes have been documented in some shape, form, or fashion to be executed, regardless of what happens to us. We know that everything is okay.
We're having to get a special needs trust for our son.
Yeah, very important document.
Oh my gosh. There's a lot to it.
It is.
Could I remind people to be thinking about who you want to trust your entire life with, all the stuff you worked with all your life, who would be a trustee, who would be whatever. Because
who's going to take care of your kids? If you just had a child, thinking about outside of, we naturally would name a godparent, but does that godparent have the financial capacity to give my child the life that I would give them, if I was living until age 18 or until they're 25, or whatever age? I would want to make sure that they're okay. Have we had that discussion on what that is going to look like, and is the appropriate documentation in place? And
are they willing to do that?
Are they willing to do it? Yeah.
Because that's a big responsibility. I'm the godparent. I will help with that part of it. But however, to raise a child is a big, big deal.
Yeah. And I mean, and finances is a huge part of that, right? It makes the decision a little bit easier if I know that I can financially support someone and give them the love and things that they need. So just knowing that that's taken care of is definitely a huge thing for your financial portfolio.
And before we roll too much further there, insurance is an important part of that. Making sure you have enough. Is there an amount of life insurance that you would recommend as a financial advisor, even just so their kids and their families or whatever are taken care of? I know a lot of people now choose cremation, so they don't have to necessarily have the big funeral expenses and the casket and all that. But what do you tell your clients?
Life insurance is definitely a variable amount, and it's intended to do more than burial. And so it really depends on how much debt an individual has, the type of income that they're bringing in. And so it's a calculation. It's something that cannot be overfunded, right? We can't just magically create a life insurance number, but the amount of annual income you make is the overall goal, because life insurance is income replacement for families. And so if, I want to make sure that my kids can maintain the same lifestyle for the next 10 to 15 years, then my life insurance amount is going to start at my annual income times that 10 to 15 year amount. And that is designed to, come into the household, whether it's monthly or lump sum, to make sure that there's no disruption to what they have going on, so they can stay in the same school, they can stay in the same house and not have to downgrade their lifestyle. And the second thing is to make sure that I don't leave debt to anyone. So if I have a mortgage and I want that house to be paid off to remain in the family, vehicles, credit card debt, anything that has my name attached to it that I don't want to go to my next of kin, I want to make sure that I have enough life insurance to pay those things off. And then lastly, of course, burial. So whether it is cremation or, I have a plot that, my family has or whatever it is, I want to make sure that life insurance money is enough to do those things. Some alternatives are to make sure that the taxes and stuff have a source of funding if I do leave a house to my kids. Maintenance and taxes is one thing. If they can't afford it, then they're going to have to let that house go.
Right.
And we did all that hard work, right, for it to be sold. So just thinking through the things that you want to happen, you want to maintain for your family, that determines the life insurance number. So while you have one person that may only qualify for $500,000, you may have one that qualifies for $6.7 million. It really depends on what you have going on as an individual.
Okay. I want to be one that qualifies for 6.7. That's just a pipe dream right there for me. But what is realistic for somebody to be able to have, like in their emergency fund and in their savings account, if they're making, what would be an average salary? What would be an average income? And what would that give us the possibility to do, Paris?
So you're saying how much can I have in my savings based off of my income?
Yeah.
Well, in a perfect world, I would love to have clients have 20% of what they're bringing in, not just in an emergency fund, right? But annually, if I make $100,000, $20,000 of that needs to be in some sort of savings format. So a portion could be an emergency fund. A portion of that could be into, my retirement accounts. A portion could be into life insurance or income protection, long-term disability policies. Yeah. Like just making sure that I have spaces to go to. So I'm preparing for retirement. I have a bucket for my immediate expenses. My income is protected should I not be able to work, and then my life is protected. So it's a breakout of all of those things to make sure that I have the right amount going into savings.
Paris, I have lived so many years that you start to think I've gained some amount of wisdom. And then you come in and you talk to us. And I'm like, oh, my goodness. I didn't think of that. I didn't think of that. I didn't think of that. It's just a blessing that you have come into all of our lives, because I know there are people listening going like, what? Yeah. I need to get on that.
And the biggest question out there is the value of an advisor. And an advisor is designed to get you to do things that you naturally would not do on your own, almost like an accountability partner. And of course, naturally, you have to have the capacity to do the things that they're asking you to do, because there is a separation, right? There's a financial coach, and then there's a financial advisor. A financial coach is working on the behaviors to keep people out of debt and things like that. And, getting your credit up to date, and an advisor can do it, but there's actually two distinct roles. The advisor is the person that says, okay, we got to really make a decision. You're only putting away 5%. We need to do 20, because this is going to get you the lifestyle that you desire in retirement. And this is going to protect those healthcare costs when you reach retirement. And this is going to, impact, making sure that we can keep our Social Security and 401ks and things like that, and distribute the legacy that we want for our family members. So while an advisor can definitely be both, there's also a space where a financial coach is sometimes a little bit more appropriate if we're working from a mindset perspective, that somebody needs to understand that this is important and I need to get the behaviors in check, while the advisor is accountable to getting you to do the things, right? So now that the mindset is where it needs to be, we need to do A, B, and C. And if you're not going to do that on your own, or you don't have the capacity to do that on your own, that is where an advisor is truly valuable. Because when you look up 20 years from now, did they coach you and get you to do the things that you needed to do for your future self?
Yeah.
Because the reality is the average person is going to spend, if I give you $500 extra in your paycheck, are you going to be like, yes, I'm going to go invest this money? Most people are not, right?
No.
They're going to, I have more money to go take trips, or I have, money to go shopping. When the reality is we have to carve out that thing or that amount for our future selves.
Okay. Any final thing that you would like to add? Because we're almost out of time, but I know you always come up with that extra bit of wisdom and things that we need to hear.
I think that it is really, really important to just sit down and ask yourself, what form of love are you giving to yourself right now?
Whoa.
There's the immediate, right now gratification type of love, but is that long-term success for you and your future? There are so many people who don't know what their 60-year-old self is going to experience. They don't know what their 50-year-old self is going to experience. And the best person to take care of that future self is the person right now. And if you're in a space where you are unable to make the right decisions, you need to, just take the chance to find somebody that you can connect with, where there is a financial coach or a financial advisor, to get yourself moving in 2026. Commit to yourself.
What kind of love are you showing to yourself? Am I spending it on a big fancy dinner out? Or am I going to keep me from living on the streets when it comes time to retire?
Amen.
Oh, my gosh.
Yeah.
All right, Paris, thank you.
You're welcome, Anna Marie.
Paris Jackson is a financial advisor with Northwestern Mutual, and thank you for coming in. As always, you've been just so helpful and so kind, and not just calling us like a bunch of idiots. Because
Oh, no.
so many of us are ignorant of what to do.
Yeah.
You're helping us know what to do, and then we have to take those steps to be able to do it.
Yes.
We have to have the willingness.
Yep.
All right. Thank you, Paris.
You're welcome.
We're going to put some more links and more info on our Focus Facebook page. And make sure you join us again next week. I'm Anna Marie, and that's Focus.